For much of the past decade, conservative financial models were treated as outdated. They were seen as slow, overly cautious, and poorly suited for a fast-growing economy driven by cheap capital and aggressive expansion. Companies that moved carefully were often overshadowed by those willing to take bigger risks and promise faster growth. In 2026, that perception has flipped. Conservative financial models are making a clear return across U.S. businesses, not as a defensive reaction, but as a deliberate strategy shaped by hard-earned experience. Conservative financial models prioritize stability over speed. They emphasize cash flow durability, manageable leverage, realistic forecasts, and downside protection. Instead of assuming favorable conditions will continue, these models plan for volatility, disruption, and slower growth. What once felt pessimistic now looks practical. U.S. businesses are rediscovering that resilience is often more valuable than ambition. One of the main reasons for this shift is the higher cost of capital. When interest rates were near zero, aggressive assumptions carried limited consequences. Borrowing was cheap, refinancing was easy, and mistakes could often be corrected later. That environment no longer exists. Debt now carries real weight, and financing errors can quickly erode profitability. Conservative models account for this by using higher hurdle rates, stress testing cash flows, and limiting reliance on leverage. Forecasting discipline has tightened as well. Instead of projecting best-case scenarios, companies are building models around base cases and downside scenarios. Revenue growth assumptions are more modest. Cost inflation is treated as persistent rather than temporary. Demand variability is modeled explicitly. This approach reduces surprises and forces leadership to confront uncomfortable possibilities early rather than react later. Cash flow has returned to the center of decision-making. During periods of rapid growth, accounting profits often took precedence over actual cash generation. Today, businesses are paying closer attention to how money moves through the organization. Conservative models prioritize free cash flow, working capital efficiency, and liquidity buffers. A business that generates steady cash is viewed as healthier than one that shows high growth but constant cash burn. Balance sheet strength is another defining feature of this shift. U.S. companies are placing greater emphasis on maintaining manageable debt levels and strong liquidity positions. Conservative financial models favor flexibility over maximum leverage. Holding more cash and maintaining borrowing capacity are seen as strategic advantages, not inefficiencies. This allows companies to respond to shocks, pursue selective opportunities, and avoid forced decisions under pressure. Expense planning has also become more cautious. Instead of assuming costs can always be cut quickly if needed, companies are designing cost structures that are sustainable under multiple conditions. Fixed costs are scrutinized more closely. Variable cost flexibility is valued. Conservative models ask how easily expenses can adjust if revenue slows, not just how fast they can scale up. Investment decisions are being filtered through this lens as well. Capital expenditures, acquisitions, and long-term commitments are evaluated against stricter return criteria. Conservative models favor investments with clearer payback periods and lower execution risk. Speculative projects are harder to justify unless they offer asymmetric upside with limited downside. This does not eliminate innovation, but it slows the pace and narrows the focus. The return of conservative modeling is especially visible in hiring strategies. Instead of building teams based on optimistic growth projections, companies are aligning headcount with proven demand. Hiring plans are tied to revenue visibility rather than aspirations. This reduces the likelihood of painful layoffs later and supports more stable organizational growth. Investor expectations have reinforced this trend. Shareholders are no longer rewarding aggressive financial engineering or optimistic projections without evidence. Earnings quality, margin stability, and disciplined spending matter more than headline growth rates. Companies that demonstrate conservative financial management are often rewarded with greater trust and lower volatility in their valuations. Regulatory and geopolitical uncertainty have also played a role. Trade tensions, policy shifts, and evolving compliance requirements introduce risks that are difficult to quantify precisely. Conservative financial models incorporate buffers for these uncertainties, rather than assuming smooth outcomes. This helps companies avoid strategies that only work under ideal conditions. Another important factor is memory. Many executives and boards have lived through recent periods where aggressive models failed under stress. Rapid expansion, heavy leverage, and optimistic forecasts left some companies vulnerable when conditions changed. That experience has reshaped attitudes toward risk. Conservative modeling is no longer seen as timid. It is seen as responsible. Technology investment has not escaped this shift. Even in areas like AI and digital transformation, companies are pacing, spending more carefully. Instead of betting heavily on unproven returns, conservative models support phased investments tied to measurable outcomes. This reduces the risk of large sunk costs without clear benefits. Importantly, conservative financial models do not mean companies are abandoning growth. They mean growth is being pursued within clearer boundaries. The focus is on sustainable expansion, rather than rapid scaling that depends on favorable external conditions. Companies are asking whether they can survive slower growth, higher costs, and unexpected disruptions before committing resources. This shift has also changed how success is measured internally. Leaders are evaluated not just on revenue growth, but on how well they manage risk, preserve optionality, and protect the downside. Conservative modeling supports better decision-making by forcing trade-offs into the open. In 2026, the return of conservative financial models reflects a broader maturation of U.S. businesses. After years of prioritizing speed and scale, companies are recalibrating toward endurance. They are designing financial strategies that assume uncertainty rather than deny it. Conservative models may not generate the most exciting headlines, but they build companies that last. In an environment where volatility is persistent and confidence is fragile, caution has become a competitive advantage. The return of conservative financial models is not a retreat from ambition. It is an acknowledgement that long-term success is built on discipline, realism, and the ability to withstand pressure when conditions inevitably change.